So somebody recording? Or later?
Yes. Okay,
Okay.
so yes, good afternoon. Yeah, good afternoon to all of you.
Yes, good afternoon.
Yes, so you are welcome to today's program. And I think we have done a series of programs which were done a free online teaching, basically during the COVID period. We started with how to prepare a business plan, SME lending processes. And then recently, that was about 2 weeks ago, we looked at the due diligence process. But today, we are starting our first certificate program. And this certificate program is entitled Finance for Non-Finance Managers. And at the moment, we have a few people online already. We have others who join us. We have 5 people who registered for this program. And then basically from Myanmar over here. So you are all welcome to Silverman Financial Literacy Institute. We will start with an introduction, but before we do so, can we have an introduction from Min and then Mr. Cho? I think they are already online, so we can start with that. Can we do an introduction, please? Hello.
Hello, this is Min. Yeah, just wanted to know how to, get more financial literacy data from you, from Mr. Silverman.
Yes, please.
And I'm running my own business, and as you know, and yeah, happy to learn more.
Okay.
Hello.
Yes, please. Yes.
Oh, yeah, this is Jeremy, and I want to learn from you, so I signed up.
Yes. Okay. So please, where do you work? Where is your which company do you manage, or maybe a brief introduction like that, please?
Oh, I run Money Changer, so.
Okay.
And,
hey, is that you, Yemin?
yeah.
That's my friend.
You see, that's why it's good to do introduction, you know.
Yeah.
My buddy Yemin.
It's good to do introduction. Okay. Yeah. So we have our Alice over there. Can you introduce yourself? Open your okay. Hello?
Yeah, my name is Alice. I run catering services and other small businesses. So I want to learn from you. I want to know much about how to handle my cash flow and balance sheets. Thank you.
Right. Okay. I think HP star is it Susu?
Yes, I'm here.
Okay. Can you please introduce yourself?
Yes, this is Sue, and actually, I just wanted to learn finance since 2 years ago, but now I think I got a good opportunity to learn how to operate the finance department and how to operate the finance documentation. So I hope I can learn much more about finance from this program. Thank you.
Okay, thank you very much. So we are set to begin, and we will start. Okay, see, someone has also joined. Maybe Susu, you can admit the person. Okay, we can do the introduction later. Yeah. So basically, I'll be taking you through. This is the table of contents. We will do introduction of Silverman Financial Literacy Institute, introduction of the facilitator. That is the one speaking to you. we will look at the objective of the course, the modules that we are looking at. We have various modules within the course. We will look at the double entry principle, the mirror image of double entry principle, the golden rule of accounting, personal, real, and nominal accounts, accounting concepts. Then we are going to take a quiz that is a short test. Then we will continue with definition of accounting and finance, budgeting and planning, budgeting techniques. Then we will take the second quiz. Then we will look at the plan for day 2, which will be tomorrow. So this is the outline of our program for today. So I will move straight to the slides, and then we will look at what we have on the slides. Now, Silverman Financial Literacy Institute has a vision to enhance financial literacy and human capacity development with contemporary mixed learning model. So over here, we are talking about using either classroom mode or online mode in our teaching and delivery services. Our mission is to reach every enthusiastic learner with financial, personal, and business education and customized to the needs of individuals and institutions in an effective manner. What is our core value? Our core value is trust, innovation, leadership, and continuous learning. Now, what is the history of this institute? Silverman Financial Literacy Institute was born out of a passion for dissemination of useful business knowledge over the past 10 years. This has led to the publication of various educational materials, books, and journals in the areas of personal finance, business finance, microfinance, and spiritual development. So out of this, we registered actually Siegfried Silverman Company Limited, which is a licensed publisher. It has been licensed in Myanmar. And then this serves as a foundation for the institute. So we concentrate on microfinance, finance, accounting, and personal development, and in an offline or online study mode. That's what we do. Okay, so this is the facilitator. So I will be introducing myself to you. I know most of you knows me already, or if you don't, my name is Siegfried Kofi Badago. I'm a chartered accountant by profession. And recently in Myanmar, I was awarded as the CFO of the year for non-bank financial institution from Global Banking and Finance Review. It's a Singapore and UK-based publications. And I have a 2 master's degree, and then I'm also an ACCA member. I'm a chartered accountant. I've been in the microfinance service for the past 18 years in management consultancy and then accounting system setup. And then I work in various countries, including Ghana, Sierra Leone, Ethiopia, Egypt, Zambia, Malawi, now in Myanmar, and also USA. I'm also good at writing, and therefore I have written a few books. And then I participate in due diligence processes and fund management for large institutions. So that is that about me. And I believe some of you have met me. I know Mr. Min, we have met several times. Yeah, okay. So, and you can also see some of our publications. If you visit any of the bookshops in Myanmar, like Inwa Bookshops, Apolika, and the rest, you are likely to see any of these books. 18 Laws of Personal Development, Permanent Wealth. This we have not yet supplied to the bookshops, but Microfinance textbook, it is so far, it is doing very well in Myanmar, and then the Embattled Earth. So these are our publications. And for the course participants, today, we are going to give you one of these books. Each person will get a microfinance textbook. Okay, we'll provide this for you. So from Monday, we will arrange to give this to you. Yes. Okay. Yeah. So I think we can proceed now. So what is the objective of this course? This is what we are going to look at. Yeah, the objective of this course is a high-level course for industry practitioners with limited or no knowledge in the field of accounting and finance. So the target groups include CEOs, chief operating officers, heads of departments, head of operations, head of institutions, and things like that, okay? And the course entails the fundamental of accounting and finance, definition and history, and current development entailing the standards. So International Financial Reporting Standards and the GAAP, we call it GAAP, okay? We will be looking at that possibly tomorrow, not today. Then we will look at the three important financial statements: profit and loss account, the balance sheet, and the cash flow statement. That's going to be possibly for tomorrow. Then analysis and interpretation of financial statements. How shall we use the accounting and financial ratios to help understand the performance of the entity? And then number 4, accounting control setting to detect and prevent fraud, errors, and misstatements in our organizations. So this is what we are going to look at. So that is the objective of the course. Okay, so let's look at the modules. We have 4 modules in the course that we are going to look at. So module 1, fundamentals of accounting and finance. This is what we are treating today. We shall look at the history and development of accounting and finance. We shall look at the double entry principle, then the definition and key terms. We will look at the difference between accounting and finance. Then we are going to look at the introduction of planning and budgeting. And then we will look at the various budgeting techniques. This will be sufficient for today. Then tomorrow, which is module 2, we shall look at the 3 important financial statements, which will be the statement of financial position, the statement of comprehensive income, the statement of cash flows, then the relationship between the 3 accounts. Then module 3 is going to be the interpretation of financial statements. We shall look at the profitability ratios, the liquidity ratios, leverage ratios, and then productivity or efficiency ratios. That will be on the 3rd day. Then on the module 4, which will be the 4th day, we shall look at accounting and financial controls. We shall look at the 4 I's principle, the policies and authority and approvals. Then checking and preventing fraud, senior management roles. Checking and preventing fraud, internal audit roles. Checking and preventing fraud, external audit roles. Okay, so that is our basic model. Do we have any question at this stage?
No, not yet. Yeah.
Okay, so now let's start now with the history and development of accounting. You know, accounting has started way back into the ancient civilizations. In the early development of accounting dates back to ancient Mesopotamia, which is an old kingdom in the Mediterranean region, and closely related to development in writing, counting, and money in the early audit system by ancient Egyptians and Babylonian times. I know most of you have read about those histories. And then by the time of the Roman Empire, the government has access to detailed financial information. We know also about Roman Empire. Then in India, we have Chanakya, who also wrote some manuscripts similar to financial management books, and during the time of Mauryan Empire. His book is called Arthashastra and contains some aspects of accounting in the sovereign state. But now, the one who is more credited to be the father of accounting is called Luca Pacioli. Luca Pacioli is from Italy, and he is recognized as the father of accounting because he was able to document the books about debit and credit, and then bookkeeping. So he was the one who developed the double entry system. And then this happened in the year 1494. 1494. That is long years ago. And that is where we start accounting from, where the double entry system was developed. So after this, there have been a lot of modification and improvements. And then the modern profession of the chartered accountants originated in Scotland, in the United Kingdom, in the 19th century. So accountants often belong to the same association as solicitors or lawyers and whatever, and offering accounting services to their clients. Early modern accounting had similarities to today's forensic accounting. But accounting began to transition into an organized profession in the 19th century with local professional bodies in England emerging into the Institute of Chartered Accountants in England and Wales. So we have ICAEW, which was set up in 1880. This is the first recognized professional body of chartered accountants in 1880. So this is where we are now as the history and the development of accounting. And I belong to ACCA, the Association of Chartered Certified Accountants, which was set up in 1904. 1904. But that was set up after ICAEW in 1880. Are we okay with the history?
Yeah, it's okay.
Okay, so we are going to go ahead. Now we are going to take a quiz. That is, so you must be taking note of all the important things that I'm talking about.
Okay.
Okay, so now let's look at the double entry principle, which was started by Luca Pacioli, okay? And how it has entered into our financial reporting and things like that. So the double entry is a fundamental concept underlying the present day bookkeeping and accounting, and said that every financial transaction has equal and opposite effects, at least two different accounts. It is used to satisfy the accounting equation. So we are looking at one equation which we are going to look at more in the future, okay? Assets. So assets of the business is equal to liabilities plus equity. Okay, asset is the thing that the company or the institution or the person owns, the thing that you have. It is equal to your liabilities. That is the thing that you owe plus the equity. I will be coming back to this equation in more detail because we are going to look at the legal entity concept, or what we call the economic entity concept, and the reason why the equity here have to be added to the liabilities in order to arrive at the assets. Okay. Now the basics. What is the basic of the double entry? The transactions are recorded in terms of debits and credits. Since a debit is one, okay, so since a debit in one account offset a credit in another, the sum of all debits must equal the sum of all credits. That is how it is. Then the double entry system of bookkeeping standardizes the accounting process and improves the accountancy of preparing financial statements, allowing for improved detection of errors. Okay, so this principle also is called the dual aspect concept. The dual aspect means that the two aspect. So the word dual means two. So accounting always have two aspects. We have the debit side, the credit side. And I know there is always confusion about what is a debit, what is a credit, okay? What should go into debit, what should go into credit? So we are going to look at the next slide, which will explain to us more details about this double entry principle. Okay. Okay. So I have here what we call the mirror image of the double entry principle. And over here we said every debit entry must have a corresponding credit entry. And every credit entry must have a corresponding debit entry. Okay. This means that for every transaction that occurs, one must be at the debit side and another at the credit side. Okay, that is the basis of accounting. So I want us to look at the mirror image over here. So if you see here, there is debit and credit. And then we have the assets and liabilities. Then at the mirror image, we have liabilities and assets under debits and credit. So I will explain it over here. Now, in the balance sheet items, check here very well. Assets, accounts are debited when they are increasing. When an asset is increasing, it must be debited. Okay. Then liabilities. Liability accounts are credited when they are increasing. Are you clear about this? So we do a debit for assets when they are increasing, and then for liabilities when they are increasing, they credit them. Now let's look at the mirror aspect. What happened over here? The liability side, liability accounts are debited when they are decreasing, and then asset accounts are credited when they are decreasing. Okay, this we are going to explain them more. Now let's come to the profit and loss side. At the profit and loss side, expenses accounts are debited, sorry. They are debited here when they are increasing. So for example, if you are paying for electricity bill, your water bill, or whatever, here in Myanmar, we call it the meter bill. If you are paying for your meter bill, you have to debit that account, okay, because it is increasing, okay? Then for the income side, income accounts are credited when they are increasing, okay? This is the main reason why we always say at the bank, my account has been credited with my salary. My account has been credited with my salary. Or I receive a transfer from my brother in Europe, and then my account was credited because it has become an income account. The account has been increased at the bank. Therefore, it is credited. Now let's come here. Then in the profit and loss statement again, income accounts are debited when they are decreasing. Okay, which means that when your income is reducing, or let's say you go and withdraw money from your account in the bank, you debit the account, you are reducing the money at the bank, for example. Then expenses accounts are credited when they are decreasing. Okay, maybe we will look at an example like that, but sometimes it's very difficult to get your expenses decreasing. But mostly if you have it, then it becomes like a set-off. Okay, any question from this side before we proceed?
No.
Problem. No,
Yeah, I think there might be a question.
no question yet.
Are you sure you understand the debit and credit?
Yes, yes, understand.
I mean, better it's been shown with the.
Sorry?
If you show with the numbers, you know, when, you know, like the bank statement, it makes sense. It will be easier if you show with the numbers, which is better if you.
Yes.
Like real example.
Yes. We are going to do more numbers, especially from tomorrow. Today, we will do a lot of theories first.
Okay.
a few numbers, but tomorrow is going to be full of calculations. So
Why do you say mirror image? I mean, in where though? Like on the balance sheet, you'll have asset liabilities, and then you write debit and credit, a mirror image. So where will be the mirror image? On also the balance sheet?
okay, good. So this is the first one over here. You see that the asset over here is on the debit side. The liability is under credit. But when you come here, we also have debit, but we have liabilities here. So you can see that here, each side is reflecting over here, and then this one is reflecting over here. That is the mirror. If you come to the expenses on this, the left side, we have expenses under debits, okay? But when you come here, we have income under debit. Are you seeing it? So it is like the opposite of the two. So that is that is the mirror we are talking about.
Right. So when you enter into the one on the left side, it will subtract from the one on the right side. Basically, you will be double entry. Right?
Yes.
If you enter.
Yeah, that is what we are talking about. Yes.
Okay.
So for example, if you have increased, if you have increased your assets, automatically you are doing something else at this side.
Right.
Yeah.
So then you're double entry.
Yes, that is in order to fulfill the double entry principle. Yeah. Okay. Thank you. Okay, so we will proceed with the. I gave example over here. Okay, so that we can understand what we want to do. So the golden rules of accounting. Let's say the name of a lady is called Sue Lewin. Sue Lewin bought a phone, a mobile phone, for 400,000 chats with cash. Okay, how do we treat it in Lewin's account? So in Sue Lewin's account, we have the details, we have the debit side and then the credit side. So the mobile phone will be debited because it is like the mobile phone is received the money, so to speak. Okay, and then the cash has paid out money. The money has moved out from the cash account. So this account will be credited. Therefore, the two sides of the account is that mobile phone is debited and then cash is credited. The cash is credited because money is going out. And then you have received mobile phone as an asset. Therefore, it is debited. Are you getting it?
Yes.
So, yeah, so
Yes.
So Lewin bought a mobile phone for 400,000 chats with cash. So mobile phone has been debited, cash is credited. And then the reason why it is so is because Lewin is a personal person. Okay, let's say it's a personal. And then the principle over there is that debit the receiver and credit the giver. Debit what? This is the receiver. The phone is receiving the money. And then credit what? The giver. The giver here is the cash that is giving out the money because it is the personal account. So the first principle or the first golden rule is that debit the receiver and credit the giver when it comes to personal accounts. We have another type of account called real accounts. This is called the assets and liabilities account. You will debit what comes in and credit what goes out. Okay, it is the same thing, but you may not see it to be so. Debit what comes in. So your cash account, for example, if you have money given to you in your personal account and you have your T account, you put the money in. So you put the money at the debit side. And then credit, what goes out when you make payment. For example, here, payment has been made, therefore money is going out, like a company account. Okay. Then we have nominal accounts. It says that debit all expenses and losses and credit all incomes and gains. So nominal account says what? Debit all expenses and losses, credit all incomes and gains. So these are the golden rules of accounting. But we are going to see more of them ahead. The reason why it is so. For example, the personal account. Why is it that we debit the receiver and credit the giver? In the real account, why do we debit what comes in and credit what goes out? And then the nominal account, debit all expenses and losses and credit all income. So we are going to explain what exactly is personal account, what exactly is real account, and what exactly is nominal account. Then it will be clear to us. Any question from this side?
Can I make a guess? Hello? Hello?
Yes, yes, please. Me. Yes.
So yeah, so what I've seen before is the personal, like basically if you are doing your own accounting, right? Like your day-to-day expenses and whatnot. And then for the real, what I saw in like a bank statement, like they have both sides, right? Credit, debit and credit. So when I go to the bank to check my company bank statement, they usually have debit credit. And nominal is like when I report profit loss to shareholder or something, right? That's usually what we use, right? For the nominal.
No, personal always talk to about either a personal or maybe an individual or artificial human being, which may be a company's account. Okay.
Right.
Real accounts. Okay, go ahead.
Yeah, like spending, like my personal spending or company spending, right? Let's say I bought a computer, laptop, then I can use that, right? Say laptop, 500,000, or let's say a staff, and then the laptop goes in debit, and then I have to take out the cash, right?
Yes. So the personal account, maybe your own account at home or things like that. Okay, that is a personal. When we come to real accounts, they are accounts that do not close at the end of the period, but their balances are carried forward to the next year. So they are mostly the assets and liabilities account. That's what we call the real accounts. Okay. Then when you come to nominal accounts, the nominal accounts are accounts that exist just by their name. They are the one that closes at the end of each financial year. So they are mostly the profit and loss accounts. But I will explain it in the next slide so that you will see why it is so. Then we will come back to this. Okay, so let's look at it here. Okay, what is a personal account? What is a real and nominal account? A personal account is a general ledger account connected to all persons like individuals, firms, and associations. An example of a personal account is a creditor account. Okay, that is a personal account. Okay, a real account is a general ledger account relating to assets and liabilities other than people's accounts. These are accounts that don't close at year end and are carried forward. An example of a real account is a bank account. You see, a bank account falls under real account. Asset account, like maybe your computer account, your fixed asset account, or maybe you borrow money from the bank, it's a liability to you. It will be called real account because you carry the balance forward until you settle it. Then nominal accounts. Nominal accounts is a general ledger account pertaining to all income, expenses, losses, and gains. An example of a nominal account is an interest account. Okay, a simple one is interest account, but maybe say interest income You also have interest expense. You have your sales account, or you have your revenue account. Okay, all these will form under nominal account. And then we are saying that for the personal account, you debit the receiver and then you credit the giver. Like the example I gave in the Suluin, buying the computer or buying the phone, the mobile phone. So the mobile phone was purchased, and what happened over there? You see that the mobile phone was debited, and then the cash was credited. The reason is that it is a personal account. So debit the receiver and credit the giver. That is the reason why it is so. Is it clear, please?
Yeah, it's clear. It's clear. Yeah.
Yes. Now, these are very basic things. They are basic, but I want you to get it clearly. Then when we start treating the higher things, you may not find it difficult. That is why the basics are very necessary. And once we pay attention, and we will be able to understand it when we started treating difficult aspects of the control that we are going to talk about, the profit and loss account, the balance sheet, and things like that, and then the ratio analysis, which will come up later. Okay? Yeah, so that is that for this side. Okay. So we are going to look at what we call the accounting concepts. Accounting concepts. Do you have any knowledge about what we call the accounting concepts? What are the concepts in accounting? Okay. So the accounting concepts are fundamental principles underlying the basis of preparing accounts. They are fundamental principles. Okay. Yeah. So we are going to see the reason why they are fundamental. There are some basics. There are some things that enable us to do the way the accountants do their things. The way even accountants behave. You are going to see it today. So the first one is accruals concept. Accruals
concept?
Yeah.
Accrual concept. Okay.
Yeah, the first one. We are looking at accruals concept. The first one here. Okay. Accrual concept is the revenue is recognized when earned, and expenses are recognized when assets are consumed. This concept means that a business may recognize revenue, profit, and losses in amounts that vary from what will be recognized based on the cash received from customers or when cash is paid to suppliers and employees. Auditors will only certify the financial statement of a business that have been prepared under the accruals concept. I'll give you an example of this in detail, okay, so that you understand it. You see, when you are selling something on credit, for example, let's say that you are somebody who is selling mobile phone, or you are selling computers, and then you sell to companies, okay? Maybe your clients are companies. Then the company came, maybe their representative come to buy the computer. You have issued them an invoice, okay, for let's say the month of July. But they are going to pay the money to you in August, as an example, because you give them some credit, like maybe 1 month or maybe 2 months credit or maybe 3 weeks credit, okay? When you give them the invoice is for the month of July. And therefore, you must treat the income in July. Whether you are going to receive the money eventually in August or in September, you must treat the income in July. This is what we call accruals concept. Your income has been accrued for the period because you have recognized the income for the period in which it relates to, not when the cash is received.
You use the invoice date, right?
Yes, so you are going to use the invoice date to enter this into your financial report. So if you issue me an invoice that you have supplied me some goods for today, but I decided to pay you 3 days later or 5 days later, you have to enter the invoice in your book for the day in which you put on the invoice. This is what is called the accruals concept. Okay, I think there's a question, Alice. Your mic is off. You unmute. Okay. Hello. Okay. Yeah, go ahead.
Yeah. What of if I receive the invoice for July, and then receive the cash in August or September, and I treat it into July accounts as receivable or money in the accounts. And unfortunately, my client failed me for not paying me at that month. Maybe for example, this coronavirus issue happened. I know so many checks and the invoices have been put on hold. How do I treat that?
Exactly. That is a great question. Thank you. So if you have recognized the income for July because you issue the invoice in July, but in 2 months' time, your client fails to pay you, that is where we do something we call provision for bad debts. You have to do a provision in your account that the client might not pay the money. And if eventually the client have not paid, then you will treat it as bad debts in the account. But I think when we come to the real figures on the profit and loss account, we are going to look into details of that. So normally we do provision for bad debts. That means you provide that maybe the client you have issued the invoice to will not pay you 10% of the amount or 20% of the amount. Maybe the client will only pay 80%. So you make a provision of 20% in the book. Then 2 months later, 3 months later, the client fails to pay. Then you have to write off the amount, which becomes a bad debt in the account. That is how it is treated. Is it okay?
Yeah, it's okay.
Yes. Yeah, so that is the accrual concept. It's very, very important in preparing the profit and loss account. And we are going to see them in figures. Then I will explain them more when we come to the figures. Okay, Madam Alice, are you okay with the question?
No, she's not good.
Hello, Alice, are you okay? Okay, let's go ahead. Let's look at the second one, conservatism concept. Conservatism concept. Revenue is only recognized when there is a reasonable certainty that it will be realized, whereas expenses are recognized sooner, or when there is a reasonable possibility that they will be incurred. This concept tends to result in more consecutive financial statement. It results in what? More conservative financial statements. Now let's look at it also here. When you have an invoice again, let's go back to our first point of invoice. And then you have let's say somebody called you from on the phone. Let's go back to the mobile phone sales again, or let's go to other, maybe computer sales or whatever. Then somebody called you. Oh, maybe your name is Suluin, or your name is Susu. The person called Susu. I want to buy 2 of the computers tomorrow. So get ready, I will be coming and pay for it. You are not supposed to recognize this in your accounts because the person has not actually fulfilled what he said he or she will do. So the revenue here is only recognized where there is a reasonable certainty that it will be realized. So if there is a certainty, that is the person has actually taken the order, have actually come, and then that is where you are going to. But if it is not, you are not to recognize this. But however, as we explained in the first example, and let's say you have issued out the invoice by the person maybe in 2 months' time or 3 months' time, you must make provision for it, that in case the person doesn't pay, you must make sure that there is a provision for bad debt. That is how it is. So that is the conservative principle. We also call it prudence concept, if you like. Others call it prudence. Prudence means that carefulness. You have to be careful. You are conservative or you are prudent. So it's also called prudence concept. Any question from this side?
Can you explain what about why expenses are recognized sooner in this concept?
Exactly. So
Sooner than revenue.
yes, expenses actually consume income. So we must make every attempt to provide for them and recognize them as soon as possible. But income must be carefully considered before you recognize them, because the person might fail to pay. The income might fail not to come. I mean, the person refused not to pay the money. So it is very difficult to get the money back into the income. But for the expenses, you know, expenses always happen. Like this lockdown situation, you know, most of our company, we are still paying staff salary. But our income is dwindling. Our income is reducing. But we are still paying staff salary. We are still paying for the transport. We are still paying for that. So expenses must be provided for as soon as possible in the account. But you take a great care in recognizing your income. That is the main reason why. Yeah, have I answered your question?
Delay in payments, right? Some delays in payments or failure to pay.
Sorry, please say it again.
So because of delay in payments and failure to pay, right? Because conservatives, you don't recognize the revenue until the payment is made, right?
Yes, because of delay payment, or sometimes the person might not pay, or sometimes something happened, and then yeah, that is why. Okay, so we are going to look at the consistency concept, the third one. Okay, once a business chooses to use a specific accounting method, it should continue using it on a go-forward basis. By doing so, financial statements prepared in multiple periods can be reliably compared. Okay, this is recently I've published an article on this consistency concept. I think I will give you the link so that you will read the article I wrote. Consistency concept says that when you choose one method for doing your accounts, you must apply the same method from year to year or from period to period. You shouldn't change. And if you have any reason to change, then you must provide a reason for the change and also the effects on the financial report. So, for example, we're in the depreciation of your fixed assets. You could use what we call straight line method for doing depreciation. That is, the cost of the asset is spread equally over maybe 4 years or 5 years or things like that. The exact term are expressed equally. We call it straight line method. You continue to use that every time. You don't have to change. There is another method called reducing balance method. Reducing balance method, it means that every year you are going to be reducing the provision for the depreciation, because you charge higher from the first, and then you deduct the depreciation from then you charge the next one based on the net figure, or what we call the net book value. Then you continue to charge the net book value. So it's a different method altogether. The first one is only going to base on the cost of the account, the cost of the asset. So this is what we call a consistency. You must be consistent to choose one method, and then you should not change. Maybe this January you are using the one method, then the February you are using a different method, March you are using a different method. No. If you do that, you will find the accounts to be changing, and then you cannot compare the account effectively, and then accounts cannot be reliable because there are inconsistencies in the reporting. This is what we call the consistency concept in accounting.
What was the second method? The depreciation, straight line depreciation, and then the other one was?
Yeah, we have the straight line method. We have the reducing balance method. There are various methods. You are reducing balance. You can also call the annuity method, and other methods are there.
Oh, right, annuity, right.
Yeah, annuity.
But I know it as annuity.
Yes. Okay, so when you select one to use, you must be consistent with it. You should not be jumping from one to the other. Yeah, that is the meaning of this consistency concept. Okay. Any question? Susu, any question?
No, not yet. It's clear.
Okay.
Yes.
And then Mr. Shaw.
Yes, it's okay.
Are you getting it?
Yes, I'm getting it. Yeah, straight line method and the balance decline method. Yes, I got it.
Not too difficult, eh?
Yeah, it's easy. Yeah.
Consistent, right? Because you cannot keep changing year to year. So.
Okay, thank you. Okay, so please let's move on to the next. Okay, the legal or economic entity concept. I know most of you know about this. I believe strongly you know about it. The transactions of a business are to be kept separate from those of its owners. By doing so, there is no intermingling of personal and business transactions in a company's financial statements. So it means that the company and then the owner of the business are two separate human beings. The financial transaction of the business must be kept separate from the owner's business. It must not be the same. And therefore, you should not treat your personal expenses as business expenses. You should not treat your business expenses as personal expenses. The same thing, if you have an income for the business, the income is for the business, it's not for your personal use. And then if you have a personal income, it is also for your personal, it's not for the business. The two must be kept separate. Have you come across this before?
Especially in Myanmar, his money, my money, their money, everybody's money is his, like the owner.
Yeah. Yeah.
That's you.
Not me. Yeah, I agree with it.
Yeah, so basically your business transactions must be kept separate, and then your personal transaction must also be kept separate. So in one of the, okay, if you see the equation I gave first, we call asset is equal to liabilities plus equity. So you could see that equity is a money that the owners have invested into the business, or let's say the shares of the business. And the shares of the business is a liability account because the business is owing this money to the owners. Then the owners of the business are also having an investment in the business. So equity account or share capital account is always a liability account. It is because of this principle. It is because of this concept of the legal entity concept or the economic entity concept. Because the owner is separate from the business. And therefore, whatever money you, the owner, has given to the business, it has become a liability to the business. And whatever the business has given to you as the owner, it will be in the form of a dividends or drawings from the business, so that the two should be separate. Is that clear?
That is clear.
Yeah.
Yes.
So that is what we have to. Any question, please? Okay. So we are going to look at the other one, the going concern concept. The going concern. Financial statements are prepared on the assumption that the business will remain in operation in future periods. Some of the books will say in the foreseeable future. Okay, in the foreseeable future. Okay. Under this assumption, revenue and expense recognition may be deferred to a future period when the company is still operating. Otherwise, all expenses recognition in particular will be accelerated into the current period. Well, it's a little bit of confusion, but I'll explain it to you. The going concern concept means that the business is seen to be a future or futuristic event. You don't plan the business so that by tomorrow you close down or tomorrow you fold down, okay? And therefore, in recognition of your assets and liabilities, for example, you have purchased a computer today, you don't charge all the costs of the computer to your profit and loss, but you carry it as an asset so that you can provide depreciation on it from year to year, maybe 3 years or mostly 3 years, okay? Or you buy air conditioning for your office. You don't charge all the costs to your profit and loss account because of the going concern concept. It means that the business is supposed to be in existence for the foreseeable future. And that is why we have assets and liabilities. Otherwise, everything has to be treated in 1 year of each purchase. And if you do that, that means you will not have a balance sheet. You will not have an asset, you will not have a liability. But it is a going concern concept which created assets and liabilities. Are we clear about this?
Yes.
Yes.
Yes. Okay. So we are going to look at the matching concept. Matching, not the match pass during the military meetings.
Please, I want to ask one question.
Okay, please go ahead, Alice.
Yeah, about the legal economic entity concepts.
Okay.
You know, in some companies, the owners just said, just give order that, okay, transfer this money into the accounts, into their personal accounts. How do you treat that one?
Yes,
because they have the upper hand in the company, you as an employee, then your boss said, transfer this money into this account for me. How do you treat that one?
Yes, so if the owner of the business is transferring money from the business to his or her personal account, it depends on the type of business. If it is a sole trader, let's say if it is a one-man business, then this will be treated as a drawing. We call it drawings in the books. But if it is a company limited, maybe limited by shares or limited by guarantee, then this could be as part of his or her dividends. It's like he's taking part of the profit already from the business. And therefore, this could be treated as a dividends payment on account, maybe in advance, payment of dividends in advance or payment of dividends on account. And they are the same thing. On account means that in advance. Okay, so these are the treatment that we, the accountants, we do. If the owner of the business is doing same, by taking money from the account, you can record it as a drawings if it's a sole trader. If it is a company, it will be dividends.
Okay, thank you very much.
Yeah, thank you.
Welcome, sir.
Okay, so we are going to the matching concept. Matching concept. The expenses related to revenue should be recognized in the same period in which the revenue was recognized. By doing this, there is no deferral of expenses recognition into later periods, so that some viewing a company's financials can be assured that all aspects of a transaction has been recorded at the same time. Okay, so matching concept simply means that the income and expenses of the same period must be matched together. So income for July, expenses for July must be matched in such a way that we will be able to determine your profit or the loss. You should not push one forward and then push one backwards. You are matching them on the same period. That is the explanation that I can give over there. Okay. Yeah, and then we have materiality concepts. Material is coming from the word material. What is material to you? Another word in English is what is important to you. Is it material or is it immaterial? Okay. So materiality concept. Transactions should be recorded. When not doing so might alter the decision made by a reader of a company's financial statement. This tends to result in relatively small size transactions being recorded, so that the financial statement comprehensively represent the financial result, the financial position, and the cash flow of a business. The explanation is not as deep as I will explain it to you verbally. The materiality concept means that items that are immaterial, if they are immaterial, they should just be treated in the profit and loss account. If it is a material thing, let's say you purchase an air conditioner or a deep freezer for your business. You see, it is a material item that is of a certain size, and therefore you can choose to treat it as an asset instead of treating it as an expense in the account because it is important. The important items which can last beyond 1 year or 2 years are treated as assets. But if it is very immaterial, for example, you buy just a pin for the office or a staple machine for the office, or those little things, they are immaterial things. And therefore, they are treated in the profit and loss account, just for the period in which it relates to. You don't have to carry it forward from year to year, despite the fact that those things will last beyond 1 year. Are we getting it?
Yes.
For example, if I buy, let's say, a small truck for my delivery, so it's an asset, delivery van, right?
Yeah, delivery van.
Hello?
Yeah.
Yeah, but then if I get a flat tire, then buy a tire, I wouldn't use that as an asset, right? I would just put it in my expense because it's a flat tire. Just change the tire for the car.
Yes. So depending on the
So
cost of the item, Yeah, if the cost is very small, or it is very immaterial, you just treat it in the profit and loss account. But if it is a big
Right.
item, yeah. Yes.
So car versus a tire, like car is, let's say, $10,000, but the tire is only like, $50. So it's big difference. But I still use the asset, but change the tire, right?
Yes, yes. But only your voice is not very clear. Sometimes I didn't get the
Sorry.
last
Maybe the
submission.
internet. Maybe internet connection. Yeah. Yeah, the car is an asset, but the tire is more like an expense because I have to change it basically every year, right?
Yes, yes, so to speak. Though sometimes the tire could last more than 1 year, but the cost might not be all that big. Therefore, you can choose to just treat it as an expense item. But the car itself, the body that you purchase may last for about 3-4 years, and therefore it become an asset. Yes, yeah, I got you now. Yes.
Okay, thanks.
Okay, thank you. So we have come to our quiz. Who is the father of accounting?
The Piccoli guy, Italia.
Sorry?
The Italian guy, Piccolini or something.
Okay, who remember the name, the father of accounting?
Luca.
It said start with Luca. Luca, yes? Okay, the name is Luca Pacioli.
Pacioli, right. Pacioli.
Luca
Pacioli.
Yeah, Luca Pacioli. Yes.
Okay.
Okay, Luca Pacioli. Okay. Number 2. Which year was the first accountancy profession formed? Which year was the first accountancy profession formed?
Is it the 1880s? Where is the ICAEW?
Correct. Thank you. Yes. 1880. Yeah, that is the year that the first accountancy profession was formed. Okay. Name one of the golden rules of double entry.
Personal, real, and nominal.
Yes. Yeah, under the rules, there is something. We have personal, nominal, and real, but there is something stated. Yeah, we have something stated under each of them. Can you remember one of the rules that stated under maybe
Yeah,
for example, personal?
For personal, debit the receiver, credit the giver.
Okay, great. So the first one, debit the receiver and credit the giver.
And the real, real normal, real debit what comes in, and credit what goes out. That is for real.
Okay, great. Thank you. Yeah, I have great students.
Yeah. Debit all expenses and losses, and credit all income and gain for the nominal.
Wow, great. Thank you. Thank you. Thank you very much. You see, you are all learning.
Good teacher.
Yeah, great students. Yeah. Thank you. So the last one is, what does the Liga or economic entity concept mean? What does this mean?
It means it's the principle that it states that a business entity's finance should keep separate from the owner and partners and shareholders and other people. So it basically separates that like the money that belongs to the business and the money that belongs to the owner.
Okay, good. That is true. So we must separate our business from what the company or the business does. Our activity, personal must be personal, business must be business. something like that. Thank you very much. So we have done over 1 hour now. Can we have 5 minutes break?
Yeah.
5
Yes.
minutes break, and then we will come back, okay?
Okay. Yeah.
Yes.
That's
Yeah.
good. That's good.
Okay. Thank you very much. So yes. And
Yes, thank you.
yes. So
So we leave the Zoom on, or
yeah,
we start again?
you can just leave your Zoom on. I will not close. Then we'll
Okay.
come back.
Okay.
Okay.
We're going to take tea.
Yeah, you can go and
Yeah.
take your tea or go to the washroom or whatever and come back.
Okay.
Yeah,
Okay.
no tea
Yes.
for you.
Thank you.
Okay.
Beer.
Okay. Okay, you are welcome back. So I will share my screen again. Okay. Okay, we were here, but let me share my screen. Let me go back and share the screen. Okay. Okay, can you see my screen?
Yep.
Yes.
Okay, this is where we just complete. We just finished the quiz about the fundamentals. We look at the fundamental aspect, and then we look at the accounting concepts, and now we will proceed to the next stage. We are now coming to the accounting and finance. Are we all set? Hello? Are we okay to proceed?
Hello, yo, bro.
Yes.
Hello. Eh.
Hello?
Hello.
Hello, Mingalaba?
Eh? Hello.
I was just telling you to switch off your mic.
Hello.
Fabula. Sorry.
Yeah, I was calling you to come back.
Sorry. I was taking a thing. Okay.
Yeah.
Okay. Sorry. Yeah.
Babila,
sorry.
Babila.
Yeah. I'm ready now. Okay.
Okay.
And thank you, Komimo.
Okay. So we are now
Okay.
starting with the accounting and finance. Okay.
Okay.
Now, what is accounting? Because we started with the bookkeeping definitions and whatever. We have not defined accounting. Accounting is the recording of financial transactions, along with storing, sorting, retrieving, summarizing, and presenting the result in various reports and analysis. Accounting is also a field of study and profession dedicated to carrying out those tasks. So that is a basic definition of accounting. It is the recording of financial transactions along with storing, sorting, retrieving, summarizing, and presenting the result in various reports and analysis. So if we talk about storing, that means we keep the financial reports into files and store them either electronically or physically. Okay, sorting, we sort them so that they will be in a proper arrangement. Then retrieving, we are able to retrieve the information when needed. And then summarizing, the financial reports are normally summarized. You can go and look and get the details later. And then presenting the result to various reports and analysis. Okay. Normally, accounting is divided into two. We have financial accounting and management accounting. We are going to look at this later on. So financial accounting talks about reporting to the outsiders. And then management accounting is for the internal reporting purposes. So those are the main things, okay? So there's a too broad. Then another is finance. You know, accounting and finance are not the same, though they move together. But finance is a term for matters regarding the management, creation, and study of money and investments. Specifically, it deals with the question of how and why an individual, company, or government acquires the money needed, called capital in the company context, and how they spend or invest that money. So in actual fact, finance deals with investment, planning, management, and things like that. Whilst accounting is about the reporting and keeping the records. That is the difference between the two. So accounting has been there before finance was born. I always tell people that accounting is like the father, and then finance is like the son. Accounting was there before finance came. So finance is just a portion of it, talking about management, creation of study of money and investment. Typically things concerning investment, planning, and decision making are in finance. Whilst accounting keeps a lot of records, reporting, analysis, and things like that. Are we okay with this definition?
Yes.
Too difficult or too simple?
Too simple.
Too simple. Yeah, okay. We will go ahead and see how simple it is. Anyway, but we are going to do more of this, okay? So let's move on. Where does finance or financial management come from? Finance is a field that is concerned with the allocation of assets and liabilities over space and time, often under condition of risk or uncertainty. Finance can also be defined as the art of money management. Okay? And then financial management focuses on ratios, equities, and debts. When we talk about debt over here, we are talking about loans. Okay, you got to obtain loan from them. It is useful for portfolio management, distribution of dividends, capital raising, hedging, looking after fluctuation in foreign currency, and product cycles. So financial managers are the people who will do research and based on the research decide what sort of capital to obtain in order to fund the company's assets, as well as maximizing the value of the firm for all stakeholders. It also refers to the efficient and effective management of money or funds in a manner as to accomplish the objectives of the organization. This is what I do on a daily basis as a CFO. I'm a CFO of a microfinance company. Okay, so I do financial management by taking care of the company's finances, raising capital, talking to investors, making sure we are able to pay for this investment and the cash flow management and things like that. So that is what we call financial management. Then I have under me accountants who looks after the recording and the transactions and making sure that they are properly stored and filed and things like that. Are we getting it? So the accounting and finance are related, but financial management is more of a management of investment, the taking for funds or allocation of resources and things like that. Whilst the accounting is concerned with the reporting about how the company is performing, and then profit and loss, the balance sheet, cash flow, things like that. Whilst the finance is concerned about bringing in the money and where the money should be invested, where it should be and where not to be, and things like that. So finance is more related to economics. more related to economics. I think we are going to go to that and we will have a look at it. Do you have any question on this side?
Yeah, I think it's interesting how accounting was created first, and then how finance is superseding it. Like we have CFO, we don't have a chief accounting officer most of the time. We have chief financial officers who manage the funds, but also use accounting as the reporting side only, right? So it's funny how the father is now ruled by the son.
Yeah, the son is ruling the father, so to speak. Yeah, but the basis is always the accounting. If you don't have the accounting knowledge, you cannot be the finance manager. That is why in every organization, before you become a CFO, you must be a chartered accountant. You must have obtained a training at a CPA or maybe SCCA or ICAW or whatever. So you have to have accountancy profession. But to be the finance, head of a finance or things like that. But as I said, accounting is more mundane. That's an English word I use. Mundane means that it's more of routine work. Routine, like every day you are repeating the same thing. That is more of an accounting. But for finance, it's more of a planning, budgeting, allocation of funds, where to get money from, where not to get it from, and things like that. So that is why a finance is more interesting than the accounting. Yeah. So are we okay?
Also in finance, you do a lot of forecasting, right? Forecasting of revenue, forecasting, but in accounting, you can't really do forecasting, right?
Yes, forecasting is also under finance. That is why we have planning, budgeting, and things like that. Yes. Yeah. Okay. All right. So let's look at the difference between the two. The difference between the two. Definition of accounting and finance. So I have this picture here. We have accounting here, and we have finance over here. Okay. So accounting is the practice of preparing accounting records, including measuring, preparation, analyzing, and the interpretation of financial statements. These records are used to develop and provide data measuring the performance of the firm, assessing its financial position, and paying tax payment, okay? Let's look at the finance side. Finance is the study of money and capital markets. We deal with many of the topics covered in macroeconomics. You see, I mentioned that it is a link to economics. It is the measurement and control of assets and investments, which focuses on the decisions of individual, financial, and other institutions as they choose securities for their investment portfolios. So that is finance. Then we come again, measuring, preparation and analyzing and interpretation of financial statements to collect and present financial information. That comes under accounting. But under finance, decision-making regarding working capital, issues such as level of inventory, cash holding, credit levels, financial strategy, managing and controlling cash flows. This comes under finance. Then to see how the company is performing, to monitor the day-to-day accounting operation, and for taxing, this comes under accounting. To forecast the future performance of the business. This is what we talk about, the planning aspect, budgeting. Then accounting, we have balance sheets, profit and loss ledgers, positional declaration, and cash flow statements. But under finance, we have performance reports, ratio analysis, risk analysis, estimating break-evens, returns on investments, etc. So you see the relationship between the two. So finance is more related to the future or futuristic in nature, by making estimate, projections, or forecasting, and controlling of the management and cash and the rest. Whilst accounting is about keeping the records and making a report on them and making sure that they are reported effectively according to the standards and procedures in place, or maybe let's say the accounting standards. Are we okay with the two? So do we see the difference now between accounting and finance?
I see sometimes in the companies locally, they confuse the accounting and finance because they put the chief accountant as a financial officer, and that's the problem because the chief accountant does not know sometimes how to do the ratio analysis and estimating break-evens and return on investment. Because the chief accountant only reports the profit loss and cash flows, you know. So they have, I see a lot of problems in local companies putting account like just a chief accountant as the financial manager.
Yes. That is true. Your observation is right. We have a lot of people who are more of accountants than financial managers. Because the financial manager must be more forecasting and analytical in mind and be able to provide the reason why we should raise some money, we should take some loan, we should provide for the future issues and the rest. Whilst accountant is concerned about making the report and getting all reports are done. So it's more of like a nitty-gritty thing of managing the past performance of the business, so to speak, or the day-to-day routine.
Right.
Yeah.
The historian, like basically the accountant is an economic historian, versus finance is more like a future thinker, right?
Yeah.
And also finance needs to know about the business. Like the financial officer usually needs to know how to run the company also, right? Because the accountant is just reporting how it's run. Finance guy has to know how to run in the future, how to survive, right?
Exactly. Yes. Okay, I'm coming. I think there's some noise coming from my this, and so I need to mute my. Okay, I'm back. Yes, thank you. So that is the observation. Mr. Shaw, any observation from your side?
Oh, yes, yes, I got it. Yeah, financial accounting and finance.
Mm-hmm.
Yeah.
Okay.
I understand. Yeah.
That's good. Okay. So we will move to the next slide. And so we are now coming to the budgeting and planning stage. What is a budget? Okay, so a budget is a financial plan for a defined period of time. A budget is a financial plan for a defined period of time. So it may also include planned sales volumes and revenues, resource quantities, costs and expenses, assets, liabilities, and cash flows. It expresses strategic plans of business units and an organization, activities, and events in measurable terms. So normally budgeting or planning is always about focusing for the future and how you want things to be done in the next 1 year, next 2 years, next 3 years, things like that. That comes under budgeting. And it is very important for every business to plan ahead of time. That in the next 1 year, where do you want to be? The next 2 years, where do you want to be? In the next 3 years, where do you want to be? So this comes under financial management, as we have already looked at. So over here in the picture here, we have the budget. So you are talking about your finance, where the fund will come from, where the cash, your expenses, your savings, and then coming to the accounting. So somebody is drawing about the plan over there. And then we will look at the details of the budgeting later. So, under the preparation of budgets, that we have what we call the profit center. So what is a profit center? A profit center is a branch or a department or a division of a company that is accounted for on a standalone basis for the purpose of profit calculation. A profit center is responsible for generating its own results and earnings, and as such, its assets generally have decision-making authority related to product pricing and operating expenses. Profit centers are crucial in determining which units are the most and least profitable within an organization. So when we talk about profit center, you look at your organization, wherever you work. There is a particular unit that is responsible for bringing money into the company or bringing income to the company. That is the part that we are talking about as profit center. Okay, it may be your sales department, for example. A sales department is always called a profit center because they are responsible for bringing in sales into the company. If you go to the banking or maybe microfinance, we have the operations department. They are the one who disburse the loan to the clients and making sure that the monies are collected back and whatever. So that is operations department in banks or microfinance institutions. They are the profit centers. And you must know how to manage your profit center. That is because they are the one who make sure that money comes in, the profit comes into the organization. Are we clear about this? Profit center. Okay, not too difficult. Yeah, not too difficult, yes. But let's go to the cost center. Okay, a cost center is a department within an organization that does not directly add to profit, but still cost the organization money to operate. Cost centers only contribute to a company's profitability indirectly, unlike a profit center, which contributes to profitability directly through its actions. So for example, managers of cost centers like human resource department, admin department, ICT, internal audit, accounting and tax, public relations are responsible for keeping their costs in line or below the budget. So for example, if you are working in an organization and you have a human resource department, admin department, or ICT, or internal audit, accounting, they are all cost centers. They only consume cost. They don't generate profit. But the profit center will be the sales department, the one that goes to the field to bring the money, or the one who generates the sales. So mostly the market, how do we call it? The sales department or the marketing department, it depends on how the organization is structured. That is the one which is profit center. Whilst we have the cost center, which are mostly the service centers to the revenue or the profit centers. Have we seen these differences in our companies or in our organizations? Or can we see example?
So whatever is costing money is a cost center. Like for example, expenses, whatever you spend on staff and whatever. But if they don't create any revenue, right, it will be a cost center.
Yes. Any department that doesn't create revenue, doesn't generate revenue. So for example, your accountant in your office doesn't generate any revenue, but your accountant makes sure that all your financial reports are prepared on time. So it's like a service center, or we can call it cost center. Then if you have a sales department or a sales manager, the sales manager is always contacting the clients and making sure people buy your product or you sell your services to them. That is a profit center.
What about marketing? Sometimes it's a cost, sometimes it depends, right? Marketing department.
Yes, marketing department could be. That is what I said. Let's go back to the profit center. So it's a department or a division of a company that is accounted for on a standalone basis for purpose of profit calculation. So basically, if you have the marketing department going to make marketing to your client or potential clients, in order to bring money or to bring sales into the business, then this could also be regarded as the profit center.
What about advertising? Because it's usually under marketing. If you do advertising or Facebook boosting, would you put that, you know, as a profit? Because only when you do Facebook boosting, sometimes you get the profit, right?
Yes, but I know that advertising is a cost center because they always consume cost. They consume cost, but indirectly they contribute. Like the definition over here, the second one, cost centers only contribute to a company's profitability indirectly. So they are able to boost the sales or whatever through advertising and the rest, but they are not responsible for making sure that the sales come. So somehow they are in the middle. Yeah.
I've seen in MFI, right, microfinance, you invest in ICT, like better systems, better ways of doing business on digital, right? But it's a
Yeah.
cost. It actually helps you to process more loans. So that also contributes to your bottom line, right? Instead of paper all the time.
Yes. So not normally when we invest in an ICT, we have to look at the return on investment and see how beneficial is the IT cost that we incur. Because mostly, yes, it enhances. The costs incur enhances the profitability, but not directly. So for example, if the loan officers are using tablets or they are using some computer system, it improves the workflow so that they are able to do their work easily. Then we are able to attract more clients and therefore give more loans and the thing. So ICT is responsible for that. But how beneficial are those things that we have invested in? So you have to do what we call return on investment and to see the benefits of those investment into the ICT. Yeah.
But that will be the financial manager job, right? Not the accountant. Accounting usually just put the cost of the ICT and they don't really look at the ROI because ROI is under finance, right?
Yes, ROI is under finance. ROI is under finance. Yeah, so they will look at it. I think basically what we are just talking about is on the next slide, and when I move there, we will see it. Let me go. Okay, so when you come, the last one will be the investment center. Okay, so an investment center is a business unit that can utilize capital, that is investment, to directly contribute to a company's profitability. Companies evaluate the performance of an investment center according to the revenues it brings and through investment in capital asset compared to the overall expenses. Capital asset here means investment in banks, the other businesses, and properties that generate rental income. I will explain it later, but let me come here, down here. So you see cost center. So evaluation of measures, they look at cost control, quantity and quality of services, okay? Then a profit center, they focus on profitability, okay? And then the investment center, we are also talking about return on asset and residual income and the rest. So for the investment center, for example, of a bank, maybe the treasury department. The treasury department is responsible for putting short-term liquidity into a short-term investment and making sure that we generate some small money on those short-term excess cash, for example, like buying treasury bills or bonds or securities and things like that. That is an investment center if you consider a bank, for example, or financial institution. But if you go to other institutions, there could also be investment center. If it is a company that deals in investments, they may have investment department. Then they may have the loans department. Then they may have equity department, something like that. Yeah. Are we clear about this? So these are part of the budgeting side, which I will be explaining a few things on, and we will look at that. So we have come to the budgeting techniques. Okay, we are coming to the budgeting techniques. We have 4 budgeting techniques that we are going to look at. We have zero-based budgeting, traditional budgeting, activity-based budgeting, incremental budgeting. Okay, we already look at the definition of a budget already as a written estimation of the financial performance of a particular department or a specific project or a business unit or an organization. So budgeting primarily is activity of preparing the budget. Okay. Now let's look from here. I want to go this way. I'll go this way. Starting with traditional budgeting, because this is the first type of budgeting. It considers last year's budget as the base. The changes are done based on the inflation rate, consumer demand, market situation, etc. I will explain it in the next slide. Then we have activity-based budgeting. Activity-based budgeting is a budgeting method where budget is prepared after considering the cost drivers. It does an in-depth analysis of activities incurring costs. Okay, activities that are incurring costs. Then we have incremental budgeting. In this, the current year's budget is prepared by making changes in the past year's budget, considering the inflation factor. It's a quick and easy method of preparing budgets. We will look at the details later. Then we have zero-based budgeting, ZBB. Current year's budget is prepared from the scratch without considering the budget of the previous year. So these are the 4 budgeting techniques, but we will look at the details over here, the explanation over here. I think this will help us. Yeah. Okay. So the traditional budgeting, as I explained on the previous slide, is a method of preparation of the budget in which last year's budget is taken as the base. Current year's budget is prepared by making changes to previous year's budget by adjusting the expenses based on the inflation rate, consumer demand, market situation, etc. The same thing applies to the sales. So when we say traditional, that is the old way or the former way or the normal way of doing the budgeting. You just see the old budget and compare and then begin to adjust. Then you prepare your new budget for this year or next year or the future years. So that is called the traditional method of preparing a budget. Okay. But activity-based costing, you are going to look at what are the cost drivers. We normally call something cost drivers. What activities that drive the costs of the business? So it's called a costing method that identifies activities in an organization and assign the cost of each activity to all products and services according to the actual consumption by each. This model assigns more indirect costs, overheads, into direct costs compared to conventional costing. Conventional means the traditional concept. Do we see any difference over here? Are we?
Yes.
Yeah. So the traditional way is you just prepare you look at today's budget and then you try to compare and make an adjustment for tomorrow. Okay. But activity-based, you look at what are the drivers of the cost. For example, if you look at your company at which you work, what are the drivers of cost? Is it the air condition in the office that increases the electricity bill? Or it is because of the deep freezer in the office that increases the electricity bill? And if you talk about your transportation costs, why are the transportation costs going up? Is it because your sales officers are always going to the field to visit the new potential client? That's why cost is increasing. How best can you do that? Can you contact your clients through the email or through the phone calls so that you don't have to incur more activities in terms of transportation? So you look at each of the activities that increases cost. This is what is called activity-based costing. Yeah. Okay, then there we have incremental budgeting. It is more like the traditional budgeting, but a little difference. But incremental budget is called an incremental budget. Is a budget prepared using a previous period's budget or actual performance as a basis, with incremental amounts added for the new budget period. The allocation of resources is based upon allocation from the previous period. It is more of an improvement on the traditional method, actually. So incremental budgeting is, for example, in one of the articles that I have written, I think when I share the slides with you, I will also give you those articles so that you read. You will enjoy it a lot, because I normally link some of these things to personal life. Okay, so let's say that incremental budgeting, you are studying as a student, but you continue to add more information to your existing stock of knowledge. I would describe it as incremental in the way you are doing things. But let's say that you want to change your course altogether. Maybe you are doing accounting, you don't find it interesting. Therefore, you want to go and do medicine, and you stop studying altogether. Then that is the fourth one that we are coming to as zero-based budgeting. You are starting everything now from ground zero. And then you are changing all your ways of doing things as if nothing has happened. So that is what we call zero-based budgeting. So let's go there to zero-based budgeting. ZBB is a method of budgeting in which all expenses must be justified for each new period. The process of zero-based budgeting starts from a zero base, and every function within an organization is analyzed for its needs and costs. For example, the budget that you prepared this year is not relevant anymore for next year. You have to look at every aspect and see whether all those costs needs to be justified in the new year that you are preparing the budget for. So looking at it in new altogether. So you are starting from ground zero for each year. That is called zero-based budgeting. And I link it in that article I'm talking about. I link it to personal life. Like, for example, you are doing medicine and you don't find it interesting, and now you want to change over to go and do accountancy. You have to leave all the old books in medicine because they are not relevant to accountancy study. You must come and buy new books in accountancy before you can study and pass your exam for the accountancy exam. If you are doing something like that, it will be described as zero-based. You are starting from ground zero. And budgeting also, you can do the same thing by using a zero-based, but it is always difficult to do that because you have to always consider everything again and again, which is not necessary. Are we okay over here?
So what do you recommend for a business? What kind of budgeting activities?
Yes. The most common budgeting techniques that is used is number 1 and number 3. The traditional method, which is normally you use the current year's budget is prepared by making changes to previous year's budget by adjusting the expenses based on inflation rate, consumer demand. That is very common. Let's say, let me say about 50 to 70%. Then we also look at the incremental budgeting, which is point number 3. It's also very common. You also increase based on the quantity or whatever, and it's very linked to the first one. This is a very common way of preparing a budget in organizations. Activity-based is also good, but you must have a system in place to be able to analyze the cost. You need to identify each activity in your organization. What drives the cost? What drives the income? So if you are able to identify your cost drivers, then you can use activity-based costing. And so majority of accountants, like me, for example, I don't use activity-based costing. We mostly use incremental budgeting or traditional budgeting method for most of our budgets because it is simpler to use. You can just adjust the volume or the quantity or the unit or change and things like that. Zero-based budgeting, it will be very ideal, but it is very time-consuming to do. Starting everything from the scratch and trying to build it up as if they didn't exist yesterday, you know, that is more so. It is mostly not used in organization, though it is an ideal situation that it should be used. Yes.
So not usually in real life, you haven't seen many companies use that zero-based, right? Because it's starting every time. I don't think it's very practical for our kind of, you know, continuing businesses. So.
Yes, it's true. Zero-based budgeting is not very common. It's very difficult to do because it's time consuming by starting everything again and making sure that they are like as if you didn't start last year or whatever. So it's quite difficult. But activity-based one is used mostly in America. Majority of them use activity-based costing because you need a good accounting software to be able to identify the cost activities, and then you'll be able to budget accordingly. And if you can put the cost drivers in there, you can be able to do. So I think, but zero-based budgeting is scarcely used. It's scarcely used, yeah. Okay. I think we are getting close to the end of our lessons today. Because today, as I said, is more of theoretical.
Okay.
But tomorrow we are going to do more calculation.
Okay.
So we have another quiz coming up. What is accounting? What is accounting? And then,
recording of financial transition.
okay, recording of financial transactions. Okay, any other definition?
It's storing, retrieving, summarization, presentation of the results of various reports and analysis of the records, right? And it's a field of study of the profession.
Okay, great. Yeah, a very holistic definition. Thank you. Then number 2 is, what is finance?
Yeah, it's the management of large amounts of money. It's also similar to economics.
Okay, good. Thank you. So it's like management of money mostly. Okay, that is good. Then what is zero-based costing? ABC. Zero-based. Actually, I confuse you over there. Zero-based. It should be zero-based costing, not ABC.
It's ZB.
It should be ABC, activity-based concept. And we can look at the ZBB, the zero base. So
when you start from zero, right, for every budget year, you start from scratch, right? So that's not commonly used, but it's very difficult. So zero-based something, ZBB. Right?
Yes, zero base, yeah.
So zero at every budget period.
Yeah, true. Okay. Yes.
And activity-based is the costs that are incurred by the activity to either generate profit or loss.
Yeah, so that's an activity base, and then this is zero base. Okay, and what is a profit center? What is a profit center?
It's a branch of a company that deals with the profits of the company.
Okay, that's good. Maybe a
Whatever
unit.
generates income and profit for the company.
Yeah, where profit is generated, a unit or a department of a company where profit is generated, where income is generated.
Oh.
Yes.
Example, sales. Yeah, sales income.
Yes. Okay. You have done a great job today by going through all these basic things in accounting, and which we shall be building on tomorrow in our work. So tomorrow, we are going to look at the 3 important financial statements, which is the model 2. We shall look at more calculations. So we are going to look at the statement of financial position. We shall look at the statement of comprehensive income, which is also income statement. We shall look at the statement of cash flows. Yes. And then we shall look at the relationship and then the link between the 3 statements. So we are going to see more figures and then the link tomorrow. And then when we come again.
Yeah, excited, yeah.
Yeah. So are we okay with today's lessons?
Yeah, yes.
Have we learned anything from it at all?
Yes, learn something different.
Okay, great. Yes, so thank you very much. I will send you these slides in the email.
Yes, thank you.
And then also, yes, and then we will prepare for tomorrow. Tomorrow, same time,
Yeah.
3 p.m.
Yes.
We can do this.
Okay.
It will also be good to see your faces because sometimes I am speaking to people I cannot see.
Yeah, I understand. So yeah, tomorrow we do video.
Tomorrow we do video, eh?
Yeah.
Can you see me? Because my internet very slow.
Okay.
Hello?
All right.
Hello?
Thank you.
Thank you.
Yeah, my camera not working. I don't know what's wrong with it.
All right. So we will end our lesson.